Hey everybody, it's Econ with Dave here, back with another video. Oriental Rise. I bought this stock literally 2 days ago at like 47 cents. It had a good market cap. I thought that the book value was around $2-ish. I said, oh well, this was a really interesting little, Chinese, Asian, company. And I said to myself, that's a great diversifier. That'll really help me. I want to LOL and say this morning they actually hit warrants. Dropped the price by over 66%. So this video is to remind everyone, anything could happen at any moment. I'm not a better trader than any of you, and you're not a better, all of you collectively aren't better, than me. Trading is really fucking difficult, and it's why that, it's so important when you're trading stocks to use math in terms of having equally weighted positions, being very smart about how you allocate capital, continuing to keep cash, looking for buying opportunities, rerunning the book. But I wanted to talk a little bit about this stock because I wanted to give people the reminder of something called the value trap. I think recently I've been having a very hard time figuring this out on my own. And I kind of want to go over it with all of you and speak to you about what I go through with my processes and how I'm thinking about this. So right now, this stock, theoretically, on book value with a 16% drop, actually gave them, I believe, $16.2 million cash. That's added on top of the cash that was already had. Their debt is very little to none. They actually generate a positive amount. If I'm not mistaken about this stock, I believe it was... I think it was 3 people. There are 3 companies or 3 individuals that buy the bulk majority of their tea, and that was the biggest worry going into this because I bought it a few days ago, so I remember the entire pitch that I had for it. Now, there is a actual probability. I think the book value is still around $2. There's a chance that it's worthless and it's a value trap. But this is a great example that I want to keep for all of you. So first things first is this. We thought that after this recent, drop in terms of warrants, that it would be, it's considered ultra cheap on capital market structure. It has all the hallmarks of a value trap. Now the question is, it is a 92% discount to book. The question is that an opportunity? When I was actually buying it and owning it beforehand, it was almost at 60 cents. I believe it was almost a 40, 50, 60% difference to book value. So the reality of it is the following. Now, will the cheapness persist? Will it deepen? Will they go ahead and once again, because there is a very small probability that they actually then choose for a second discounted deal the same way that was done today, that would make the shares worth 70 cents a share instead of the $2 that I think the book value is now. But here is the analysis currently. So the cash to debt right now, if we're correct, they're looking at around, let's see here. So the cash at the time was around 43. I think it was maybe, I don't know if it was 43,000 or, not. But they're roughly able to get, it was 43 million to a debt around $2 million was the liabilities. Please excuse me, everybody. They had a 14.8 million offering priced at around 46 cents a share. That was what happened today. That got me a 66% loss on my end. It's actually grossed them around $6.9 million. It was a 7% placement fee and a $100,000 expense cap. That was net cash of around $6.34 million. That actually would put cash today at around $50 million, leaving it completely debt-free with a net cash ratio of around 47.339 million. Let's see here. So when we're looking at the cash flow over the next, 3 years, you're looking at it to be an estimated 8.5 million worth of gains if everything stays where it needs to. They have just such a huge net cash position, and that's what makes me really confident. There's a chance that all that money could vanish. There's a chance they could have major losses. There could be a chance they do very large capital investment into the business, causing that to actually shrink. All of these are a pretty huge probability that could change the scenario on a quarter-to-quarter basis. But right now, the market in today's price now at 16 cents a share is actually going to be pricing in the market values. The market believes the company is worth 12% of net cash and 8% of the book value. So on top of that, at the end, let's see. I'm going to go ahead and just kind of do some quick, double checking here. So originally the fair market value was around $2. After the Dilution, we have it really at around $1.70. If you actually count 2026 getting diluted, they're really worth today 65 cents today. Now, again, we'll see what happens. So even on full dilution, today's 16-cent trades at around 0.25x net cash and 0.2x our worst case fair value. With no financial leverage, fresh cash and warrants that are unlikely to inject further cash. Zero expense is economically rational. The stock looks deep value, not a value trap. The key risk is execution. A sustained 30% revenue slide would erode cash and push it below 40 cents of value. Otherwise, the market is pricing in a crisis, as the balance sheet simply today does not show. So the book value right now is roughly $2.08. The cash is $1.34 a share today. The net cash minus the debt would be $1.29 a share. So it's fully diluted once again. It's still 3 times the stock price. So that's what's interesting, because we've already gotten to a point over here where, at least on my end, it just doesn't make any sense, and that's the value trap. And I'll be willing to put in maybe an additional 5 to 10% capital on top of this trade. I'm not selling anything. I'm going to stay tight. We'll see how it plays out. If it actually goes to zero, it is what it is. It was a little under $125, so it is what it is. But the funny part is, when you have a well-diversified portfolio and you end up getting a little bit lucky, it's funny because when you look at my account on Robinhood, and you end up pulling it up, and then you end up seeing it, then you're going to kind of be left for a second looking and going, what the fuck? Because now my portfolio was down big in the morning, but then once all the other assets started trading, everything balanced each other out. I mean, that position by itself represents less than 0.5% of my entire portfolio. So I was down $66 just on this trade today in a single day. But I only lost as a collective $8 in my entire portfolio, and I was negative 0.18, and the general market, the S&P is negative 0.01. Now I'm not going to compare myself to that because they have more appreciated assets and I don't have distressed assets. But when I'm thinking about it and I'm over here looking at it, it just hits me, and then I'm just over there in the corner going, I'm not willing to double down and put another 100 down, but I'm willing to buy a little bit on the nibble and see what happens. If the next quarters it gets crushed and it turns into a penny stock at like a penny, and the book value when I look at it changes because they're burning through the cash or they do something ridiculous, then I'm going to sell the shares, walk away, and say, well, then it is what it is. Do I think I'm going to make that money back? I have no fucking idea. But the fact that I was well positioned and my stock portfolio held up very well underneath a day sliding. I've never bought a stock that slid in a day. So bad, very, very bad timing on my part, but this is a lesson that I want all of you to be able to learn, because when you're stock trading, and if you take it serious, you have to remind yourself every day, you're not a good stock trader. You're not better than anyone else. Even the best people in the industry may get 40 to 50% of everything that they pick wrong. And the idea is getting that other 50% correct and getting, 100, 200% on that over a long enough time period, or short if the market is hyperbolic. So then you can be able to really find what you need and honestly be as careful as you can possibly be, because man, shit can flip like a dime.